Welcome back to HFS Finance, the channel where we break down complex financial topics and help you navigate the ever-changing world of money. Today, we have a hot topic that affects us all, the rising cost of homeownership. So grab your favorite brew, sit back, and let's dive right in. You know, it's no secret that younger generations are finding it harder than ever to buy a house. The dream of owning a home seems almost unimaginable. But what's truly baffling is that despite this, home prices continue to soar. How is that even possible? Let's begin by understanding the concept of affordability. Saving up for a 20% down payment on a house feels like an impossible task for many. And as if that's not enough, skyrocketing rents with little notice make it even more challenging to build up that necessary savings. Yet, owning a home with a 30-year mortgage is often cheaper than renting in most cities. So if you can buy your own home, you'll not only be richer now, but also in the future. Unfortunately, recent data from Redfin paints a grim picture. In 2022, only 21% of homes on sale were considered affordable, down from 60% in 2021. That's a shocking drop, indicating that affordability is at an all-time low. But here's the kicker. Even if people can't afford homes, prices keep climbing. You might be thinking, wait, how does that make any sense? Well, here's the first reason. Houses don't need to be affordable for you specifically to buy one. There's an entire industry dedicated to making it possible. The housing market operates on a different set of rules. While wages haven't kept up with house prices, a 20% down payment increases at only 1/5 of the rate, so people can still enter the market, albeit with difficulty. Let's look at the numbers. According to Zillow, the average home sold in America in 2020 was $230,000. Fast forward to the start of 2023, and the average home price had jumped to $330,000. That's an increase of $100,000 in less than 3 years. Even if you save diligently, it's challenging to keep up with such rapid growth. The average American salary after taxes leaves them with a take-home pay of around $49,000. Saving 70% of that would still leave you far from your goal after 3 years, given the same rate of increase in home prices. Lenders and banks who have a vested interest in real estate assets are well aware of the struggle. They have adjusted their approach to accommodate buyers. According to the National Association of Realtors, the average down payment for a first-time home buyer is just 7%. This means that even with a tiny down payment, home prices can increase multiple times over your income before it becomes impossible to buy a house. And here's where it gets interesting. Companies like Zillow are stepping in to help people who cannot save money with a new product. A 1% down payment loan. Zillow contributes an additional 2% at closing, acting as a grant that doesn't need to be repaid. So while houses are making more money than you are, the entry price is being reduced through innovative solutions. However, let's not get lost in the temporary silver lining. We must explore the bigger picture. The second reason home prices keep climbing is that people are simply not selling their homes. The number of home sales in America is at its lowest level in a decade, despite population growth. Why? Well, homeowners with favorable mortgage rates don't want to sell because the rental market is even more unaffordable. Moving into a new home would mean taking on a higher interest rate on their new mortgage and competing for rental space. And that brings us to the third reason why this cycle can go on longer than we think. Investors. All cash buyers, people moving interstate, and investors see opportunities in this market. The wealthy, fueled by selling their old homes, are looking to downsize and take advantage of high prices. Others are moving to cheaper cities where their income can buy them more house for the same money. But investors, using financing to buy properties. This influx of investor interest exacerbates the situation. They're not just buying one home, many are purchasing multiple properties, turning them into rental units or flipping them for a profit. This reduces the available housing stock for first-time home buyers and drives prices even higher. Now, let's discuss the role of government policies and economic factors. Interest rates, set by the Federal Reserve, play a crucial role in determining mortgage rates. Lower interest rates over the past few years have made borrowing cheaper, encouraging more people to buy homes. However, this increased demand, coupled with a limited supply of houses, has pushed prices up. Moreover, the government's response to economic challenges, such as stimulus packages and tax breaks, can indirectly affect the housing market. These policies often increase consumer spending power, which can drive up demand for homes and, consequently, their prices. It's also worth mentioning the impact of global events. The COVID-19 pandemic, for instance, caused a significant shift in housing preferences. Many people sought larger homes with space for home offices, contributing to a surge in demand for suburban and rural properties. But what about the supply side? Well, there's a shortage of new homes being built. Factors like rising costs of construction materials, labor shortages. This shortage further fuels the rise in home prices. The culmination of these factors creates a perfect storm. The demand for homes is high, supply is low, and investors are snapping up properties, leaving fewer options for average homebuyers. This situation makes it increasingly difficult for many to achieve the dream of homeownership. In conclusion, the rising cost of homeownership isn't just about affordability. It's a complex issue influenced by a myriad of factors, including economic policies, investor activity, global events, and market dynamics. As a viewer of HFS Finance, understanding these elements can help you navigate the challenging waters of the housing market. Thank you for joining us in this insightful discussion. Don't forget to hit the like button, share this video with friends, and subscribe for more financial wisdom. Stay informed and empowered on your financial journey. Until next time.